Hey, really nice to have you here. Let's talk about volatility and why you should trade the most volatile currency pairs. The reason actually is quite simply the volatility itself. If the market moves more, it's better than a market that moves just a little, right? It makes sense. If you have a trade on, you want a big movement. You want actually to have the big potential for your trades. So let's go and identify some highly volatile markets, and then I'm going to give you a strategy that you can either use as it is or modify it so that you are feeling comfortable with it. So really nice to have you here, and let's go and study this together. First of all, please do remember that we don't provide any investment advice, and all the material is made available for educational and marketing purposes only. And please remember to subscribe to the channel. That would be a great help. Thank you. Volatility is something that can be a little scary to those traders who haven't been in this business very long. They tend to bring this investor kind of mindset into trading. You know, investors love peaceful and calm markets that are trending higher bit by bit. But if you are a trader, you want to see the markets moving quickly up and quickly down. You want to see the trends, you want to see the ranges, and you want to see a lot of movement inside those market formations, really. So there are lots of benefits in volatile markets. First of all, trend followers love the markets where trends last for longer. Then bigger price swings is something that swing traders love. And if you are a day trader, you certainly want to see a bigger daily profit potential, because it's very difficult to trade a market that hardly moves. If it just fluctuates up and down without any real commitment on either side, then it's difficult to make money as a trader. So you definitely want to see longer lasting trends, bigger price swings, and larger daily profit potential, whether you are trend follower, swing trader, or day trader. Different traders look at volatility through different lenses, so to speak. So if you are a position trader, you are interested in the annual range of the market. If you are a trend follower, you want to know how much the market can move in 1 month's time, or say over a 2-month or 4-month period. If you are a swing trader who wants to find 2 to 3 trades per week that last from 1 to 2 days to up to 4 or 5 days, then obviously you want to know how much the market usually moves within, say, 1 week period. And then that will impact your choice and selection of the markets you trade. Then if you are an intraday trader, you will look at the daily range. Say if you're looking to catch, for instance, 40% of the daily range. Then obviously the bigger that range is, the easier your job will be. It's very difficult to trade a market that has tiny ranges. Then if you are a scalper or an intraday trader, then you would be probably looking at the ATR indicator, say for instance 20 periods, and that would help you to understand how much the market usually moves or how much it has potential to move after you take the trade. It will impact where you place your stops and targets as well, but that's a topic for another video. Now I have 4 markets here. These are pound USD, USD yen, Aussie dollar versus USD, and Euro USD. And as you can see, I have some ranges here. These ranges basically tell us how much the markets have moved over a period starting from the beginning of 2022. So as you can see, we have Euro USD moving only about 20%, even though that's a little misguiding now at the moment, because Euro USD often doesn't move this much. But now, because of Fed really missing the boat with inflation, they had to hike the rates aggressively, and that moved the dollar pairs more than normally. But if you are looking to maximize your trend following skills, then you probably want to trade USD yen rather than Euro USD, just because over the same time period there is so much more profit potential in USD yen. USD yen moved almost about, say, 34% over the same time period that Euro USD moved only 20%. So you definitely will look into trading USD yen or pound USD over Euro USD. So let's move forward. I hope that this makes sense to you. As a trader, you need to be interested in your profit potential, and volatility is actually a great measure of your profit potential as a trader. This yearly range, the recent yearly range, gives us a very good idea on what's been happening in the markets lately. So it's relevant for us as we trade the markets. We want to know what's been going on and how volatile the markets are now and how volatile they have been recently. But at the same time, this only tells us what's been going on in about 1 year. So if we move from the yearly ranges to monthly ranges, we can have a longer time period and we can study a longer time period with lots of observations. So here I have the data from the May 2002 to March 2023. And you can see that on monthly ranges or on monthly basis, pound USD has been the most volatile market. And New Zealand USD has been the least volatile. So obviously, this already gives us a very good understanding on what we want to trade. We rather trade pound USD than Aussie or New Zealand. So there's more profit potential here in pound USD. Let's take a look at this market in a little bit more detail. Here I have the monthly ranges in pips and basically descriptive statistics for them. And as you can see, the mean is 623 pips. And the range is quite big as well. It's basically the smallest monthly range was 178 and the biggest monthly range was 2,609 pips. So that's amazing, that's huge. And then if we compare these numbers to New Zealand USD range, then the mean is only 385. So the average month is almost one half of what the USD range, pound USD range was. So again, these are here to highlight the profit potential in pound versus or in a volatile market versus a market that isn't that volatile. Then there's a market that is even better than pound USD, and this is pound Aussie. As you can see, the monthly average range in pound Aussie is about 1.5 times the 623 pips in pound USD. So definitely you should look into how to trade pound Aussie. If we look at the maximum the maximum range, it's about 5,000 pips, 4,869 pips. That's amazing compared to only 2,609 pips in pound USD. So let's move into the weekly ranges and let's see how pound Aussie is actually moving inside the weeks on average. Again, we're talking about a sizable chunk of data. This is from 2003 to 2023. So that's about 20 years of data. And you can see that in the weekly charts, the average weekly range is 446 pips. The minimum is only 95, but the maximum weekly range was 4,276 pips. So this might be boring to some of you, but when you understand the data that you are dealing with, it means that you understand more about the market you are dealing with. If you are a swing trader, then you want to know that on average your profit potential is somewhere around here, 446 pips, maybe even more if you hold on to your trades longer. If you happen to catch a time when a new uptrend starts, it might be actually even more than this. Obviously, it's an average number. Sometimes your profit potential is smaller, but we are talking about averages here. So if you trade pound Aussie for next 10 years and you take a couple of trades or 3 trades per week, maybe this gives you, this 446 pips here gives you an idea of what the profit potential is. Okay, let's take a look how you can find ways to catch these big weekly moves in pound Aussie. So first of all, let me illustrate the strength of this market once more. I'm picking up some of these weekly ranges here, and we can see this was almost 620 pips. Then there's another good one here. This was 455 pips. And then later on, here's a third one. This one was about 600 pips. So these are serious moves, and we need to find ways to capitalize on this market. And I'm going to show you some ideas. You obviously have to test these historically so that you personally become comfortable with these ideas and find your own ways of trading and applying these to your trading, because otherwise it's very difficult to trade when the inevitable drawdown period comes. And trust me, every strategy has drawdown periods, because there is no strategy that works in every market condition. Strategies are market condition specific, and you have to be able to identify the markets where those conditions exist and then apply the strategy. But sometimes we get it wrong, and sometimes the market just doesn't play the ball. So there'll be drawdowns created by losing trades or series of losing trades. But if you are disciplined, there'll be a time when the drawdown is over. But that time never comes if you are not familiar with the market and familiar with the strategy, if you don't feel comfortable with the strategy and the market. So I strongly encourage you to gain that trust and gain that confidence by studying historical prices. Okay, let's go to a daily chart here. So on this daily chart, I have a couple of indicators. I have the MA 20 periods and MA 50 periods. You can try, and you're welcome to test any other combination of periods, but these seem to be working well enough for me, so I'm using them in quite a few of my charts. And they are not, it is something that I need to highlight for new traders, that indicators are just indicators. They follow the price. So sometimes they are great and sometimes not so great, but they help you to see where the trends are. So for instance, the market was moving down here, and then the red moving average moved above the blue. So the 20 period moved above the 50, and the market was, after that point, it was trending higher. But you need the further confirmation of higher highs and higher lows in order to believe that the trend actually exists, because the indicators don't know that. The indicators just follow what the price does. So indicators are a highlighter, and then you can move on to study the market a little bit more closely. But the idea with this strategy is to find the periods when the market is trending higher and be a buyer on a pullback after there is a resumption of the original upside momentum. So for instance here, the market is moving higher. There's a higher high, and we have higher lows here, and the moving averages are moving higher. They are pointing higher, and the red is above the blue. So what we want to see is the market coming between the moving averages and then resuming the original momentum. So there would be the first trade idea there. Go long when the candle closes. This is the daily candle, remember. So you can apply the same principles in or support and resistance trading, for instance. You can apply those in intraday charts as well. So you do your analysis in the daily and then you move on to the intraday. And the next time the market comes down after moving higher, it moves inside the moving averages or between the moving averages, and then there is an up candle. So we have the daily momentum returning to the market, the upside momentum returning to the market. And then sometimes the market just goes through. So this filter of seeing upside momentum after the market has come here is actually a good filter, because here, for instance, the market just went through and there was no resumption of upside momentum, so no trade. And if we move forward, we see similar situations here. The market moves higher, creates higher highs, higher lows, then it comes inside the moving averages, and then there is the resumption of the upside momentum. And the same again here, and so on and so on. Obviously, there will be a time somewhere where this fails. Market either just reverses or this strategy idea fails, and that's why you need to have stops in place. You need to figure out a good strategy where your stops aren't too close, but they are still in there, so that if the market moves against you, you are protected. So I hope this helps you guys, and as I said, go back and study the historical prices, see how this strategy works. There's no point in trading a strategy that you don't understand or that you don't feel comfortable with. But with something like this, and once you know how the strategy works with historical prices, you're much more confident to start testing and trading the strategy in real life. Thanks for watching. It was really nice to have you here. I hope this strategy was helpful and you can develop something out of it. And while I go and prepare some new stuff for you, trade safe and see you soon on the next video.